What's up, everyone, and welcome back to the channel. Today, we're tackling a huge question. What are the best stocks to buy for long-term growth as we look ahead to 2026? Now, let me be crystal clear. This isn't about giving you a hot stock tip that's going to double tomorrow. This is about building a solid, long-term portfolio that can potentially generate serious wealth over time. We're talking about a strategy, a mindset for identifying winners for the years to come. I'm not a financial advisor, and this is purely for educational purposes. Always do your own research before making any investment decisions. So, grab a notebook, because we're about to break down the key principles for finding those future market leaders. Ready? Let's dive in. First and foremost, you need to focus on high-growth sectors. Think about where the world is heading. We're talking about artificial intelligence, biotechnology and gene editing, renewable energy, and the next generation of fintech. These are industries with massive tailwinds. They're not just growing, they're fundamentally changing how we live and work. A company in a booming sector has a natural advantage. It's like having the wind at your back. While a great company can succeed anywhere, a company in a revolutionary industry has a much higher ceiling for growth. So, your first step is to identify these powerful, secular trends. Where is the innovation happening? Where is the big money flowing? Start there, and you'll already be ahead of the game. Once you've identified promising sectors, it's time to look for strong fundamentals within those sectors. This is where you separate the real contenders from the hype. Strong fundamentals mean you're looking for companies with consistently growing revenue. Are they selling more products or services year after year? Next, check their profit margins. Are they profitable, and are those profits growing? A company that's just burning cash with no clear path to profitability is a risky bet. You also want to look at their balance sheet. A company with a mountain of debt is vulnerable, especially if interest rates rise. Look for companies with healthy cash flow and manageable debt levels. This financial strength is what allows them to survive downturns and reinvest in their own growth, which is exactly what we want for a long-term hold. Now let's talk about one of my favorite concepts, and something Warren Buffett swears by: a competitive moat. What is a moat? It's a sustainable competitive advantage that protects a company from its rivals. It's the reason customers choose them over and over again. This could be a powerful brand, like Apple or Nike. It could be a network effect, where the service gets more valuable as more people use it. Think Meta or Amazon. It could be high switching costs, making it difficult for customers to leave, like with enterprise software from companies like Microsoft. Or it could be a patent on a unique technology or a secret formula like Coca-Cola's. Companies with wide, deep moats can defend their market share and maintain high profit margins for decades. When you're looking for a stock to hold for years, a strong moat is non-negotiable. This brings us to the core of our strategy, thinking in terms of long-term trends. Short-term market noise is just that, noise. The daily ups and downs, the news headlines, the quarterly earnings beats or misses for a long-term investor. These are mostly distractions. What really matters are the big, multi-decade shifts. I mentioned AI and biotech earlier. Think about the aging population and the boom in healthcare services. Think about the global push towards electrification and sustainability. These are not fads. These are fundamental changes in our society and economy. By investing in companies that are at the forefront of these trends, you're not just betting on a single company, you're investing in the future itself. Ask yourself, in 10 or 20 years, will this technology or service be more or less important than it is today? That's the kind of long-term thinking that builds generational wealth. While we're talking about growth, let's not forget about a powerful and often overlooked component of long-term returns: dividend growth stocks. Now, you might think dividends are just for retirement portfolios, but that's a misconception. A company that consistently increases its dividend year after year is sending a very strong signal. It shows that management is confident in the company's future earnings and cash flow. It demonstrates financial discipline. And for you, the investor, reinvesting those growing dividends can have a massive compounding effect over time. This is called a DRIP, or dividend reinvestment plan. It's like putting your wealth creation on autopilot. You get paid to own the stock, and you use that payment to buy more of the stock, which then pays you even more. It's a beautiful cycle of growth. So, how do we put this all together? The key is to balance growth with stability. A portfolio full of nothing but high-risk, speculative tech stocks can get crushed in a downturn. On the other hand, A portfolio of only slow-growing, stable companies might not give you the returns you're looking for. The sweet spot is a mix. You want those innovative, high-growth potential stocks from the sectors we talked about. But you also want to anchor your portfolio with some of those blue-chip companies that have strong moats and a history of dividend growth. This balance helps you sleep at night. Your stable companies provide a foundation and cash flow, while your growth companies provide the potential for explosive returns. It's about building an all-weather portfolio that can perform well in different economic environments. Even the best company in the world can be a bad investment if you pay too much for it. Valuation matters a lot. In the excitement of a bull market, it's easy to get caught up and buy a great company at a terrible price. You need to have a sense of what a company is actually worth. You can look at metrics like the price-to-earnings or P/E ratio, the price-to-sales ratio, or use a discounted cash flow model. The goal isn't to be perfect, but to avoid drastically overpaying. A good strategy is to make a watch list of great companies you want to own and then wait patiently for a fair price. Market downturns and corrections are not something to fear. They are opportunities to buy wonderful businesses at a discount. Patience is a superpower in investing. Of course, we can't just invest in a vacuum. We have to monitor macroeconomic factors. This means keeping an eye on things like inflation, interest rates, GDP growth, and unemployment. You don't need to be an economist, but you should understand how these big-picture forces can affect your investments. For example, high interest rates can make it more expensive for growth companies to borrow money and can make investors favor safer, value-oriented stocks. A recession could impact consumer spending across the board. Being aware of the macro environment helps you understand the context of the market's movements and can help you adjust your strategy if needed, without panic selling based on scary headlines. So, how do you actually put your money to work? One of the best methods for long-term investors is dollar cost averaging. This means investing a fixed amount of money at regular intervals, say $500 every month, regardless of what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices are low, that same amount buys more shares. This simple technique takes the emotion out of investing. It stops you from trying to time the market, which is nearly impossible to do consistently. And over the long run, it lowers your average cost per share. It's a disciplined, steady approach that is perfect for building wealth over time. Just set it, forget it, and let the power of compounding do its thing. Finally, always be on the lookout for emerging leaders. The dominant companies of today might not be the dominant companies of tomorrow. Remember when Yahoo was the king of the internet? Or when Nokia ruled the mobile phone world? Things change. Your job as a long-term investor is to identify the next generation of leaders. These are often smaller, more innovative companies that are challenging the incumbents. They might be riskier, but the potential rewards can be enormous. Dedicate a small portion of your portfolio to these more speculative, high-growth plays. Follow industry news, read about new technologies, and try to spot those disruptive companies before they become household names. This is how you can potentially capture those life-changing, 100-bagger returns. And there you have it, a comprehensive framework for finding the best stocks for long-term growth in 2026 and beyond. To recap, focus on high-growth sectors, find companies with strong fundamentals and wide moats, think in long-term trends. Don't forget dividend growers, balance your portfolio, pay attention to valuation, watch the macro environment, use dollar cost averaging, and keep an eye out for emerging leaders. It's a marathon, not a sprint. The key is discipline, patience, and a commitment to continuous learning. Thanks so much for watching today. I hope you found this breakdown valuable. If you did, do me a huge favor and hit that like button and subscribe to the channel for more content on investing and building wealth. Let me know in the comments what high-growth sectors you're most excited about for the coming years. I read every single comment. Thanks again, and I'll see you in the next video.